Good Sunday afternoon, everybody. I hope you're having a fantastic day. We're going to be talking about what's happened with the Fed this past week. We're going to be talking about your favorite person in the government, Jerome Powell. I have a special guest today that I've never had on the show before, but he's been a close personal friend of mine, I think for 8 years, 9 years, something like that. So I'm very excited to have him on, and he's new to YouTube, so you guys be kind to him. But first, I want to tell you, do I look any different? Do I look a year older? Because yesterday was my birthday. And if you haven't yet, make sure you get your flu shot. I don't care how you feel. If you're into flu shots, get your flu shot. My kid got her flu shot, did not get her flu shot. She wakes up Friday. She's like, I got a little scratchy throat. Her and her friends go out to the movies. All three of them tested positive for the flu. I got my flu shot, so I feel safe to take care of her. So if you're into vaccines, this is the year to get your flu shot. Oh, where did Ryan go? Uh-oh. Hold on. He's going to be coming on. So I have a special friend on this week. His name is Ryan Larussa. He is with GMFS Lending. He's a close personal friend of mine. And for some reason, he has blacked out his screen and turned off his microphone. So I can't bring him on the stage just yet, but he's going to be coming on here really soon. He has been working with me. I met him years ago when he was an investor, and he would buy $35,000 pieces of junk back in the day. And now he's he's still helping all my clients here in Louisiana, and he's been a great friend. So, hello, Mr. Mr. GMFS, Mr. Ryan Larussa. And everybody in the chat, when you hear him talk, tell me what celebrity who he sounds like. So go ahead, Brian.
Smallhorn. All right. I am so excited. I am a bit nervous. I am new to this YouTube and this new world here, but I'm not new to the real estate game. I am so excited. Like I said, all weekend I've been thinking about this. And just thank you so much. It has been a great journey. I went back and looked. And it has been like 2008, 2009, Smallhorn, when you and I initially first connected, and you started selling myself and my business partners the $35,000 pieces of junk. But we really appreciate that.
It was a lot of work, man. Those little houses were a lot of work. But I will say this. There are some people in the chat that have been asking, and I don't know if you do this, but reverse mortgages or know anything about reverse mortgages. So if they have questions during the stream about reverse mortgages, is that something you can cover?
I will be happy to answer some questions with that. We're not currently doing them at this moment, but I do have a resource, and I'll be happy to share that with you. I can answer some general basic questions. Very familiar with it. Actually, my mom and I were talking about that about 3 weeks ago. She's in a situation where, hey, she's on fixed income, got a house that's paid off. We were talking about some options, and we really started exploring that and looking at that. So I do have some resources I'll be happy to share. Just looking forward to answering any questions, adding value. That's what we do. I have been doing this, as you know, for 21 years. So while I don't know everything, I feel like I can add some value to your listeners and to your fan base out there today. So I'm pumped up.
Hey, I'm just going to show you this because this is the overwhelming. Shocking. That's who you sound like, my friend, Matthew McConaughey.
That's who I was for Halloween too, by the way.
Did you really dress up like him for Halloween?
Absolutely. Yeah, why not?
How do you dress up like Matthew McConaughey?
Slick the hair back. I had me a Texas shirt on. I had my glasses here. You know, if you go back and look at some of the football games, I had some cowboy boots on. I was acting the part.
Oh, wow. Well, Matthew McConaughey has nothing on you when it comes to mortgages. You got a lot of people saying hello to you. So don't be too nervous. It's only 139 people on here right now. So
I'm good.
You're good. You're good. So the first things first is that the Fed raised the rate 75 basis points. And people have this notion that means something for mortgages. And I'm going to ask you, and I'm going to turn it to you. What does that mean for mortgages and mortgages rates?
That's a great question. You know, my phone last week, and every time this happens, my phone blows up, and people call me, they're freaking out, which rightfully so, because the education piece is where we're all missing.
Mm-hmm.
So a lot of times when the feds raise the rates, that the federal funding rate, that actually does very, very good for mortgages. Okay. And in this case right now, I'll go back to June, July of this year when the feds really started cranking things up. Actually, when they would increase the federal funding rate, mortgage rates would get better. So the federal funding rate, that affects our overnight money, car loans, CDs, lines of credit, and credit cards, which I know is killing the consumer. Look, everything is more expensive. We know that, right? But it does not have a direct correlation. However, most of our consumers freaking out, oh my gosh, our rate's at 8.5%. I know there's a ton of fake news out there. I have people texting articles to me throughout the day, sending me emails, just hitting the complete panic button because they don't understand. And frankly, nobody really does until you explain it on a very elementary basis. When the
Mm-hmm.
feds raise the federal funding rate, that does impact mortgages, but just a little bit. I mean, matter of fact, like this past week, rates we've been seeing 30-year money, upper sixes, right around 7%. And that's about where we still are. The
Mm-hmm.
lines of credit, your credit cards, all of that stuff, as we all know, that's car loans. That's what's really getting hammered right now. And the bond market, which is how 30-year rates are derived, really, to be honest with you, like it when they increase the federal funding rate. They do not like it at the rate that he's increasing, Jerome Powell, the rate that he's increasing that. And
So
that's what's
fast.
causing these major swings in the stock market and the bond market, and which is not good for any of our retirements and things of that sort. And to be honest with you, I think the guy's just over his skis at this particular point in time. We're not giving the information time to catch up. He's just quick to the trigger, and that's not what we need. I do believe that we're going to see things from an interest rate perspective come back down first quarter of next year. And we can talk more about that. But hey, they raised the rates. What does that mean? That does not have a direct correlation to 30-year mortgage rates nor 15-year mortgage rates.
Last week, there was an article that came out that said, the experts
Yeah.
predict that the mortgage rates are going to be hitting back into the fives next year. Do you think that that's possible?
Yeah, so here's the guys that I follow, and I've like I said, I've been doing this for a long time. I lived through 2008. I lived through the flood of 2016. I've been through a lot of different crazy markets. This one's definitely wild, but I do anticipate, and the guys that I follow and we follow, we're a 5.5 to $6 billion a year company, and we service all of our clients. So we follow a lot of that very closely, and we are under the assumption that yes, rates early next year are going to come back down. Hence, right now, when you do a loan, it is very, I'm going to try to keep this elementary for all of our listeners because this is important. Well, Ryan, why is it that right now when I do a loan, let's say at 7%, let's just use 30-year money at 7%, that right now it almost has a little bit of what they call a discount point included in there because Fannie Mae, Freddie Mac, all of these big time guys, they know that rates are going to come back down. They're not going to do that loan for free, if you will. Okay.
Mhm.
So that's another cost that is being passed on to the consumer by us trying to help the situation, which is totally backfiring. That's just not the case. But yes, we do anticipate rates to come back down. As you know, the cost of things and the appreciation, which I think we really need to address too, because the appreciation has been going strong for such a long time. Like I said, going back to the last 5 or 6 years, it's been unhealthy in my opinion. When I sit down with a first time home buyer or even somebody buying their second home, hey, what we've seen has been unprecedented from an appreciation. And I tell them, do not anticipate that to continue to happen. It's going to continue to happen, but not at the double digit streams that we've been seeing in a lot of markets. I tell everybody 3 to 5% is the number
Right.
we need to be
Mhm.
looking at. And to be honest with you, that's a very sustainable number. I know I do business in about 7 or 8 different states, and what I've seen across the country it's been incredible to see the appreciation.
Someone has a question for you. It says, "Why did he stop investing?" You haven't stopped investing. You don't buy
I
as
have
many
not.
homes as you used to, though, right? Or do you
Well,
still buy houses?
we
Buy
still do. We still do. I think, going back to 2008, really when Smallhorn and I really started to meet each other, and she started selling property, it was that we had all of our eggs in one basket. I'm a big diversification guy. I'm a process guy, and I
Mhm.
realized at that point I did not have money diversified. And I'll be honest with you, um, the diversification in real estate has been, but outside of marrying my wife and having two kids and a relationship with those guys, it's been amazing. We have
Mhm.
really been blessed to have some huge favor. But no, by no means have we stopped. Matter of fact, I think in the last couple of years we had such great opportunity to unload some things and to get debt free, that we decided to do that. But we're back, looking at opportunities. The last couple of years, it's been hard to find a deal, to be honest with you, Smallhorn. Wouldn't you agree?
Oh, absolutely. I do wanna ask you this. So, because rates are coming well, you anticipated them coming back into the 5s, and home prices will, continue to drop, who knows how long or how much. In certain areas, it's gonna be more than others, especially if you have a lot of new home construction. Said that 1,000 times. Do you think that people are better off waiting next year to purchase a home, or do you think that the opportunities are still here at this time?
Great question. The first time home buyer the last 2.5, 3 years has not had a chance with rates where they were. Okay.
Mhm.
And here's what we're seeing, and it's been refreshing. Last week we closed 6 different deals throughout the week, and every single one of those were first time home buyers.
Mm.
So that was encouraging, right? Because that 220 to $250,000 house was actually sitting on the market for more than 30 seconds. So these folks
Yeah,
had an
more than 30
opportunity
seconds, but
to get
yeah.
a piece of the action.
Mhm.
And with the price of rent going where it's going, my opinion right now is, hey, look, I don't like rates where they are. I'll be honest with you. I don't like them at all.
Mhm.
But this gives an opportunity for those folks that have not had an opportunity to be able to buy a house, build some equity for themselves. People are like, well, yeah, Ryan, well, what happened? Here's what I know. Rent has been going up 10 to 16, 18%, depending on
Mhm.
what you read. I know just here around Baton Rouge and where we're at, I mean, 12, 13, $1,400 a month doesn't get you much at all. I mean, it really
Mhm.
doesn't. So yes, that payment on that 220 to 250 house is higher than now, of course, but you buy it, you have the opportunity to refinance it down the way. Um, I mean, you just got an opportunity. You have not had that opportunity in the last 2.5, 3 years.
Those small houses still fly off the market. Yeah,
They do.
you do have more than 30 seconds, but it's like 45 seconds.
That's
Those
right.
those three-bedroom, little, what most people would say are first-time home buyer houses, they still fly off the market if they're maintained. I mean, they just go so fast. Is there a lag when rates are increased? Is there a lag when the rates are increased?
Is there a lag? Here's what I can tell you. I think what we all need to understand is that when the rates, federal funding rate increase last week, that day we knew it was coming, right? That wasn't a
Right.
secret. Everybody knew it was 75 basis points. The com- the comments from Powell, the 30-minute debriefing right after, is what
Mhm.
drives the markets crazy. It does it every single time.
Mhm.
And uh, to be honest with you, if it would just be, hey, we raised them 75 basis points, let's move on, let's check it in 30 days, it would make everybody's life a lot easier. That's not the way we work. That's not the way it works. But yes, there can be a little bit of a lag. But rates change all throughout the day, especially with the volatility that we've been seeing in the stock market.
Mhm.
I mean, you might see sometimes if you saw an eighth of a percent, change in a day-to-day market, that was a lot. Right now you're seeing, I mean, we all see it. Market goes up 700, 800, 1,000 points. Well, when the stock market has those type of swings, that makes the bond market equally as nervous. The
Mhm.
bond markets get super crazy, which that drives rates. So yes, there
Mhm.
can be a little bit of a lag in that stuff. But to be honest with you, again, we knew it was coming. It's here. Now, the big thing is what's going to happen. Everybody's like, okay, Ryan, well, what do you think in December? Well, I think in December, I do believe that we're going to see another little bump up. But to be honest with you, it's kind of like rip the Band-Aid off. Let's rip the Band-Aid off and go with it. And we're going to move forward in a lower rate environment. The concern I have with the lower rate environment, to be honest with you, is that the inventory, we all say it on every call or mastermind I'm a part of, the national, not just here in Louisiana, but the national inventory, very slim. A lot of the stuff, and look, it's Sunday, typically on Sundays from 2 to 5, I'm going through open houses, Wednesdays, checking out open houses because it's my profession. It's my duty to know what's out there. There's very, very, very limited inventory at a affordable price.
That's what I've been saying. The National Association of Realtors said we were short about over 5 million homes. And in some statistics, it says we're short about 7 million homes. But what the statistic they leave off is that it's affordable homes. We have plenty of McMansions. We have plenty of huge houses. We don't have enough of those 3-bedroom, 2-bedroom houses for people to purchase. They're just not there. And like they can give all these incentives for first-time home buyers to purchase a home, but that doesn't mean that is going to work because there's nothing out there for them to buy. Like if they were to even give, $10,000 to first time home buyers, that's not really going to help anybody. It's not going to help the market. It's not, because there isn't any houses in their price range for them to purchase. There's just not enough. That's the problem.
Well, one thing too, and look, and again, being part of a lot of different coaching groups and masterminds, we come out when rates go up. Every time rates the next topic. But when rates were in the 3.5, 2.5, 3.5% range, guess what I heard? Well, rates are going to go lower, right? Mm-hmm. So rates are going to go lower, rates are going to go higher. It's the instability that I think has the folks in the market super nervous. Okay. Mm-hmm. Those things are going to consistently happen. Right now we're doing I'm probably doing every other deal is at 2-1 buy down, to where the seller we can use a seller closing cost to buy the rate down 2 percentage points. So if the rate's 7, we're getting on a 5. So is it really a rate issue? Not when you have less than 30 days or a month and a half of inventory that's not under contract. Because that's another thing in those numbers that they put out there is a lot of times it'll say, what's under actual contract. So if those are under contract, more than likely they're going to close. So those are not really truly inventory, right? So, but it is the affordable inventory that we really got to, focus on.
Mm-hmm. There's a question for you, Ryan. It says, Ryan, if interest rates due to come back down early next year, then it's safe to say home prices may not come down as much as some people are anticipating. What do you feel about that?
Yeah, I would firmly agree with that. I'm telling you, from what I see already, I track my leads per week, and so I know when there's a slow week, okay, and I can tell you that the momentum is ramped back up, which is very odd for this time of year. Getting a lot of people because of what I just said earlier. They feel that. So when the rates come back down, you're going to have. I mean, the price. Do you think? Let's flip the question. Do we think tomorrow that rent prices are automatically just going to come back down? Absolutely not. So the amount of demand that's pent up out there, I've never seen this, guys. I've lived through Katrina. I've lived through the flood of 2016, which I'm talking about. You talk about create an overnight inventory problem. That's a major problem. The pent up demand right now, because of the price of rents and things like that, is scary, to be honest with you. But I do not believe you're going to see this major bubble, and not because I'm in this game, guys. Like I said, I own a lot of real estate. I'm just telling you what I see, and then what I see equity position wise. More people now are sitting on more equity than any time in history. Anytime. The average loan to value nationwide, depending on what report you want to read, it doesn't matter. Just call it 40 to 45%. That means if Ryan Larussa gets into financial trouble, that I've got 55 to 60% equity position. Well, what if the market corrects? Okay, let's say the market corrects 10 to 15%, which I do not anticipate based upon the demand. I still can sell that house and get out. But the bigger picture that I think, and this is the frustration part, is you've got a lot of people that are buying these properties up sight unseen, these investors, because they're tired of seeing the swings in the market as well. They're like, man, I'm not going to any longer watch the money that I might gain in the stock market, make 8 to 10%. Shoot, I'm going to go put it in real estate. At that point, I'm going to use some depreciation. I'm going to, do some cost segregation. They're looking at all of those things. So do I think that the inventory issue is going to be fixed anytime soon? Absolutely not. We're looking at several years of houses being built nonstop. And you saw the builder sentiment here just a couple weeks ago.
Oh, they're always in a bad mood.
Yeah, absolutely.
They feel icky. They have felt icky
Icky.
for a good 7 months about the housing market. They have felt really, really bad. They've had a tummy ache about the housing market. And they quit building, but they got into multifamily units, which is fine because that eventually, once those are complete, that's going to help the rental market. But that doesn't help the inventory that is needed for those affordable homes. That's the part that sucks.
That's right. That's right.
Yeah. Derek Gonzalez says, question, is seller financing a thing? With interest rates so high, there should be some sellers willing to offer a lower rate to entice buyers. Has it been done? Is seller financing a thing?
I mean, we see some of that, but again, not really. I mean, we think rates are not high. I can tell you go get a seller, or let's call it we call it bond for deed here. They're going to require a pretty big down payment, which most people don't have. They're going to charge you much higher interest than what's going on, because why would I not? So we really don't see that a whole ton. I mean, I've seen some deals like that done. It just but not enough to really make an impact. No.
Have you, people can do the mortgage, like a VA loan. You can buy their house for their mortgage. I think my brain is
assumable
loan. Thank you. Can they still do that? Is that still
Absolutely.
a thing? Yes.
You can.
With VA and FHA?
VA, FHA. Here's the problem, or the opportunity at hand with those, right? So somebody's like, well, I'm just going to assume their loan. The buyer has to have the difference between what the seller owes and what the house is worth. So they're selling the house for $200, but I owe only $100. Well, the buyer doesn't have $100,000 to bring to the table to assume the loan. So that's the problem with the assumable loans for most parts. But do we do them? Absolutely. But most of the time, especially in this case, they're like, well, heck, I'll just go buy a house, rural development with no money down, or VA with no money down. I'm not going to waste or use my cash to do that. So it has become a big topic, though. Hey, do you guys do assumable loans? And that answer is yes.
Yeah, people asked about them when the rates started going crazy. Oh, Simon Smith with a $10 super chat says, Ryan, you mentioned sight unseen. That is what that was the offer I got, and it was only 5% under my asking price. Although that's a reduction from the 8% my initial listing. Does have 7 days contingency as well? Yeah. Well, Ryan's talking about sight unseen. He's done sight unseen before, when there was a hot property, and like they already know, they've already done their research. So a lot of investors will go out there and they already know the area quite well. They know how it's has its ebbs and flows in that specific area. They know how much they could get for rent. So they're like, okay, this is good enough. And like Ryan had mentioned earlier, they know that they can use that as deductions and repairs and all sorts of stuff for taxes and everything. So yeah, Ryan's done it. And then they send the real estate agent out there to go drive by it. And I'm like, it has a hole in the roof and it smells like dog pee.
Like, yes, get it.
Yeah, they're like, that's a gem. That's a beauty. I'm like, you go over there because that makes me want to throw up. Long story short, has a $2 super chat and says, hey, ask Ryan about the record rental construction in progress. So what do you have to say about the record rental construction in progress? I have a little bit to say about it. You can go first.
It's funny. So I went to the LSU game, yesterday, right? And so we're driving down that way, and I'm seeing all of these, I guess you call college rentals and things like that being built. What drives Baton Rouge specifically is LSU. So I'm kind of like, okay, maybe not. But I'm gonna tell you, it's amazing at what we're seeing from the occupancy, because I'm very in tune with not just the residential part, but the
Mhm.
commercial part, right? And you see some of these big commercial things going on. I mean, they have got some massive stuff, and I'm in a little bitty old Baton Rouge. I mean, let's call it what it is. We're not in Dallas,
Mhm.
but I am blown away at the activity that is being done there, and so I mean, the progress, it looks like a lot, but I guess when you really step back and look at the numbers, I don't really feel that it's a whole lot. It's in small pockets. What about you? What do you feel?
I just think that we've had a lack of housing and even apartments. So if you have an area that's had extraordinarily high rentals and they have record rental construction going on in the area, that's only a good thing for the cost of someone that needs to rent an apartment or a home. I think
Hmm.
it's just gonna take time because even though they're building, you still have a long way to go. As soon as those buildings start, it isn't overnight. It takes a good year to 2 years to even 3 years, depending on the area, to have everything before occupancy can happen. So,
Right,
all I can say is that's a good thing for the reduction of, rental prices for someone that's looking in the future on if they're gonna be able to afford rent even.
right,
There's
right.
some people that have some family members that need to get out of their house, so more construction.
Absolutely,
More rental
absolutely.
construction could be a good thing for a lot of families.
I agree. I agree.
And like they because the builder sentiment was so crummy, they were like, well, I'll just get into multifamily because that was their safe bet. And so,
Absolutely.
but it doesn't help. We just have a shortage of supply of homes. And then there was this big thing saying, oh, we have like record high vacancy rates, but it's a lot of vacancy rates throughout the country are in areas that are vacation spots. So,
Right,
a house that would can be considered vacant because they only live there like half the year, even though that it's not considered, it would be considered vacant, even though they do live there. They just don't live there year round. And so that's
so
the shame
what
of it all.
one of the things too that I think, as I've done business now for a long period of time in this game, is the national news. We all know generalizes everything, right?
Mhm,
the Every single market, you've got to check and see what's driving that specific market, right? I
mhm.
just mentioned what's driving Baton Rouge. We know LSU. When LSU's doing well, I mean, anything you put purple and gold on, people want to buy it. It's just what it is. It's just what it is.
We are a
Okay.
very fickle town.
They're very fickle town, very, very fickle town. However, you go just 10 minutes down the way and 15 minutes down the way into Prairieville, which I know where you are, Christina,
Mhm,
and they basically put a moratorium on being able to build, right? So
mhm,
if it wasn't planned, guess what? And approved, it's done until they come back and change that. But like you just said, from start from breaking ground to finish, and we're talking 2.5 to 3 years to get a development up to where you can actually get people in. But
mhm,
it's that we're fired up, we start, then we stop, and then we shut it down, and then
mhm.
it's there's no consistency is kind of what I've seen. But every single market is 100% different of what really drives that market.
That's
And
what's
I
always
know that,
important to reach
yeah,
out to your local real estate agent to know exactly what's going in your area. Yeah.
absolutely.
Yeah, I didn't mean to cut you off, but I do have a question for you because
Go
Manuel
ahead.
is sitting there with this question. It says, when can you refinance after a purchase rates go down? When should someone actually refinance? So if they were to buy today and they had that 7% mortgage rate, when should they refinance?
Great question. So none of the loans that we do and most companies out there that I know put a prepayment penalty on a loan.
Mhm,
So that
mhm,
means that you could do it at any time.
mhm,
I always tell folks you need to make sure that it's a 1% lower rate at a minimum than what you currently have. And then, of course, we got to really look at it. How long are you going to be there? I mean, if you plan on moving in a couple years, or if you're going to be there more than, say, 24 months, then you need a refinance. If you're going to cut the term to that loan, you can do it at any particular point in time, and then you can kind of throw that 1% rule out of the window. But there is no specific timeline you have to wait, but you definitely want to lower it at least one full percentage point, which I believe, based upon everything I'm following, you buy a house now, you're probably second quarter next year going to be in a fantastic opportunity to be able to refinance and get yourself a lower note.
That prepayment penalty, that isn't that was a thing like after the last crash that people were getting into that. That's not as popular as it used to be with mortgage companies?
It's not. It's not. So what you had in the past is you had a lot of the private groups or some of the what we would call back then subprime loans to
Oh,
where
gotcha.
they would place a prepayment penalty. Fannie Mae, Freddie Mac, FHA, Rural Development, VA, none of those guys put a prepayment penalty on any loan.
Mhm.
So everybody again going back to what really caused what I lived in or lived through 2008 was high loans made by folks that were in most cases, hey, you had a teacher on paper making $200,000 over appraisal. That's gone. That's
Mhm.
gone. So that is what caused a lot of that. So if you had a prepayment penalty, and let's say it was 2% of the loan amount, well, on a $300,000 deal, that was a $6,000 penalty to pay it off early, on top of you were upside down, or you couldn't afford a payment and all of this stuff. So yes, there were so many other contributing factors to that time, to where again, this is not even close, guys. I'm just telling you, I'm not trying to sell you anything. I
Mhm.
just personally am in it and have seen it, and this is nothing even close to where we were. Will there be a correction? Sure, there'll be a small correction. Anybody to think that there wouldn't be, I just told you, I don't think anybody in real estate for any length of time would think that double digit appreciation is sustainable or good for anybody over a long period of time. But that 3 to 5% is a steady number. And if you got that or more, fantastic. But that's kind of where we are right now. That phone call happens every day, several times a day. Man, what do you think about the market? I mean, what's going to happen? But man, I'm no crystal ball projector, but I can tell you what's not going to happen. It's not going to be back in an '08 or anything like that. The factors just don't align that way.
Well, I did a video a while back saying the only thing that's going to make home prices tank the way that the housing crash bros say is if the jobs market tanks. And Jerome Powell said he keeps saying he wants another additional like million more jobs or whatever to deteriorate. But even then I was started like really kind of thinking about it, and I'm like, who goes first whenever these, jobs are, that are eliminated, right? It's the people that are on the lowest on the totem pole. Like who
Yeah.
can we get rid of? It's not the people that, are living in, $1 million houses. It's the ones the lowest, the lowest wage earners. So do you think that if the jobs market tanks that it could cause a housing crash like we did see before? Is it still possible, or do you think that equity would save them?
Well, I think the equity position is definitely going to save a tremendous amount of folks. Again, I mean, just think about the simple math of what we just talked about at 40 to 45% average equity position. Even if your housing market went down, which there's going to be some, it's no secret. Some markets, that's why I think you said it, knowing the local market that you're in is key, right? Because some markets are going to take a little bit more of a sting than others. In Louisiana, and again, I've lived here my entire life, so I know the market really well. We have a lot of different facets with petrochemical, medical, oil and gas. There's a lot of different markets. I mean, we're an hour away from Lafayette, the oil and gas market, right? And they have a much different market 1 hour away than we do right here. It's just what it is. If you go down to New Orleans an hour that way, that's a whole different market, right? But if you look at it from a bird's eye view, well, man, that's only 60 miles. Well, yeah, but that's a whole different market. And right now, you go look in New Orleans, the price point in New Orleans compared to the price point in Baton Rouge and Lafayette will blow your mind. So going back to that question, let's talk about it. Yes, it's going to have some impact on some markets. But even if you had I think a massive would be a double digit correction in the downward spiral. You've got a ton of equity that most people are sitting on. They're gonna sell that house and move on. That's what I believe.
A long story short with a $2 super chat says, ask Ryan when people will move back to the Detroits. Do you know when people are going to move back to Detroit? That isn't your wheelhouse.
That's not my wheelhouse. That's not my wheelhouse. I'll let the experts go on that. I
This
tell
is
you
one
where a
thing.
lot of people go ahead.
Yeah, this is one thing I want to somebody put out there. I'm going to put this up here, Eddie, real quick. My RE agent asked me to make sure my mortgage wasn't assumable. Otherwise, we would mention that in our listing. Unfortunately, my conventional USAA loan was not assumable. Why would they tell her make sure that it wasn't assumable?
I'm not sure, but
Okay.
most of your conventional loans are not. Your
Okay.
government back, your FHA, your VA are. The
Okay.
problem again is okay, if I'm trying to sell it for 200 and I owe 100,
Mhm.
the likelihood of that buyer wanting to bring the $100,000 difference to the table, not very likely in this current market. Even if the guy or the gal had the money, what we show them at that point is, okay, well, let's say that rate that your seller has is at 3.5 and the rates are at 7, and you got to cough up 100 grand. That would not be a good financial decision from a payment. How long would it take you to recoup that money? I would tell you, be very careful on that.
Right.
That would not be a good financial decision. Again, we get all sensationalized by the new or what's the rate or the closing cost. I think it all goes back right now, specifically what my team and we sit down with clients. What's the need? What are we trying to accomplish? Right? I mean, at the end of the day, you got to pay to live somewhere unless you have a rich aunt or uncle, which I do not. So we try to uncover that need, figure out the best loan product and program to move that person forward, and then give them a 2-year, 3-year, 5-year plan of an exit strategy if that needs to happen. That is where we really have to go back and focus on. The last couple years, 3 years, has been unrealistic. I mean, literally, you had people paying for houses sight unseen, sometimes even waiving appraisals and
Inspections.
just because of a 3 or 3.5% rate, which my mind, I'm a conservative guy, like that doesn't even register in my brain. But guess what? People did it. And people, well, yeah, well, that's going to be part of what we're talking about. It's going to cause this huge bubble. No, it's not, because they had provable income, and more than likely in most of those cases, they put down a lot more money than what you think, because they were sitting on equity from properties that they sold at premium dollar. So we had a big swing of that. It wasn't like these guys are financing 100% of the value of those homes. That's the big miss that a lot of people are not following on that end. So,
well, some of them that were, I mean, you're the mortgage guy, but I know from my end, like a lot of these people are like, I want to offer $35,000 over asking price. And they were coming out of their own pocket, cash. I've never seen so much. There was so much cash.
So much money.
So much cash. I'm like, where are people? I'm so used to working with people that are like, I have to finance everything. Can I finance the inspections too? I'm like, no, you can't. You know, like that.
Right.
So that switch, that I'm like, where have these people been? Have they been keeping this cash under their mattress all this time? Because when those rates came down, people walked in with a lot of cash, and a lot of the times when they were bidding over the listing price, they were just coming straight out of pocket of their own cash, their own money. It wasn't financed over the asking price.
1,000%. So yes, there was more money, and I think going back to where we are as a nation right now, right? We lent out so much money, right? That's why we're in the inflation issue problem that we're sitting in.
Mm-hmm.
Hopefully this will be corrected and a good healthy spot. Look, let's call it what it is. Pre-pandemic, rates were upper 4 to mid 5s. That's
Correct.
the truth, right?
Correct.
So I believe by going back to where they were and getting some stability there is going to give some more confidence. Now, we are always going to have issues, right? I mean, it's just what it is. But I think that's going to give some stability to where you walk in and you're like, okay, this week, here's where we are. And people just want to know that. Where are we going to be from? Because the housing market drives a lot of different markets, not just because I'm in it, but it does drive a lot of different facets all across the country. So whether you're talking multifamily, commercial, residential, it doesn't matter. It drives a lot of our economy. At this particular point in time, we just got to get that. We got to get through this month, November and December, and I firmly believe first quarter, second quarter of next year, you're going to see what we've been talking about. My concern is okay, now we got a major inventory problem.
Yep. Diamond Rush Media has a question for you, Ryan. It said, could you please explain how the central bank is appointed and the likes of Powell if they answer to no one or anyone?
If they answer
anyone, who do they answer to? All right. Well, I actually have the answer right here. It says seven members of the Board of Governors of the Federal Reserve System are nominated by the president and confirmed by the Senate. A full term of 14 years. One term begins every 2 years on February 1st, even numbered years. So Powell was appointed through the last president, correct?
Yes.
Yeah.
Yes.
Yeah,
so
in charge then.
Again, I think one of the things that I'm not a fan. Okay, I'll just tell you, I'm not a fan of him. But we have to give the economics time to do what they do. If you're going to increase the federal funding rate, and again, the guys that I follow are way smarter than me. They've been doing this for a long time. I've been doing it 20 years. A lot of these guys have been doing it 40 plus years. You've got to give the numbers time to catch up. Mm-hmm. And so by continuing to jack them up, jack the federal funding rate up, that's not giving the time for the numbers to catch up. I believe that you're going to see in December, after you get through the primaries next week, and you'll see that, hey, look, inflation has seemed to really tame. And so that's really what they're looking at to stop doing what they're doing, which is increasing them. Tamper down.
Tamper down. Tamper down. That's what he always says. Do you think that he waited too long to raise rates, that it should have probably been done the end of 2021? More of a slower run than what he did. I mean, because like 2021 was like housing market, everything was on fire.
Right. So, well, I think it's easy to look in the rearview mirror and think what we should have did, right? But I do believe this, and I benefited, my team, my company, we all benefited greatly by the lower rates. But there's no way in God's green earth should rates have been as low as they were. Okay, so they got super low. Now we're trying to overcorrect and go the other way, which is causing this major pandemonium. Again, if they were upper 4s to mid 5s, how could we justify them to go as low as they went? And now, from a consumer's aspect, man, you went from 3.5 to 7. I'm out. And oh, by the way, my stocks are down and my 401k is down 20 and 25%. The consumer can't handle that, right? And I don't like it either. So to look in the rearview mirror and think that we should have did something before, sure, but we should have never suppressed them as low as they were. I think that there were other options that could have been done. Now, again, we benefited, the builders benefited, lots of folks benefited from all of that. But at the end of the day, there were other options that I think could have been done. And I think a more steady approach, rather than now we're at this back against the wall, we got to do something, very hawkish type mentality. We don't like that. We can't handle that. Neither can the consumer.
I think some people got extremely greedy during that time. A lot of builders did, and they raked the buyers over the coals. So if they get a little bit hammered back at them at this point, I just don't feel bad for them. Sorry, I just don't. Some of those home builders really did a number on people, and canceled their contracts that they had in place for 6 months after they sold their house. And they're like, oh, unless you want to pay another $100,000, we're not going to give you your house now. That's wrong. Right. So those people have to eat it a little bit. I can't cry over that. I just can't. Mm-mm. Brian Thomas says, question, do licenses consider inventory is it what it is listed in the brokerages, or people selling or looking to sell houses? Inventory is like, how many people are going to be buying and selling houses, right? Like, who has it for sale? Like, how many people have it for sale? The big question is, like, they've been talking about for the last 10 years, the silver tsunami, right? That the older generation's gonna be selling their houses. A lot of the people that bought houses during this last bubble, believe it or not, were a lot of boomers that bought their second
Baby
homes,
boomers.
baby
Hmm.
boomers. Do you think there's gonna be, like, this silver tsunami of smaller affordable homes that hit the market that could help people that are millennial and younger?
Well, gosh, I sure hope so. But I just used the example a bit ago, or at the beginning of the broadcast of my parents. Okay, so this is
Mhm,
a prime example of they're on fixed income. They're sitting in a house that's paid off.
mhm,
The house, honestly, is truthfully too big for them, right? For the care, the lawn, that's. But what are their options? Because there's nothing out there for them to go do. Yeah, they could sell the house and make a good amount of money, but that smaller townhome-ish community feel, there's just not much of it. I think there's a huge need for that, and I
mhm,
think that there's a great opportunity. We just don't have it around here.
mhm,
But I think you're gonna. I, I would assume that you're going to see there's smart people out there that could see that. I'm not, I am kind of flabbergasted. Maybe, I guess, going back to what we just talked about, the profit margins, I'm sure, for the builders and the contractors are not nearly as good as go and build these 300, 400, $500,000 houses. I
right,
get that because you start looking at the cost of the dirt and the infrastructure and all that.
mhm,
But I think there's a humongous need. And to be honest with you, there's a neighborhood not far from where I live that's stood the test of time, and it's older houses, it's bigger lots, and people love that because they can go get that older house, bigger lot, got the oak trees, this, that, and the other. Go in there, put a little updating in it, and they're not these cookie cutters. You walk outside and you're right there on top of somebody, but yet
mhm,
you're still paying, a premium dollar. So I think there will be some of that. Now, this large tsunami, I don't know about that because something happens to my parents, more than like they just, that was a different generation, right? They're
mhm,
worried about me, and well, we're going to give you the house. I'm like, Mom, I don't want the house. And so I
mhm,
think you're going to have a lot of that generational stuff handed down to
mhm.
where people are probably going to sell that. But again, I think you're going to see a lot of investors start to scoop those up too. That's my honest opinion
Yeah, that's how
because
I always see it. The investors look at that and, like, I always, like, imagine wolves in the background salivating with their little beady eyes.
uh,
They can't wait. Yeah, like,
uh,
"Yeah, I'm gonna grab it up." Simon Smith, I wanna say thank you for the, super sticker. I appreciate you. I saw that there. Emmanuel has a question. What's your take on the "Date the rate, marry the house" slogan currently everywhere? I personally hate it, but you go
I
ahead.
hate it. I hate it. I hate it. I hate it. I think it goes back to what we just talked about. Education's everything, man. Look, I'm not one of these guys that are going to throw out, date the rate and marry the house, all this, that, and the other. What I am going to say is, hey, look, let's sit down. Let's assess the needs. Let's figure out where you are today, what the options are. Because here's the truth: not everybody is meant to buy a house. That's a fact. Some
Mhm,
people are meant to rent. But if we don't sit down and have an honest assessment of where you are and what you're trying to accomplish, then date the rate and marry the house, all that stuff, that's just something else for somebody else to just pick up.
I call
I
that
un-
the meme real estate, like, if you can sum up real estate in just a meme, then then you need to just
yeah,
walk away.
yeah.
Do
Let's
meme
let's
posts.
sit down and talk about your needs. Let's figure out what we're trying to really accomplish. Because it might not be, some people are like, well, Ryan, well, I'm just going to wait. I'm cool with that. Let's
Mhm,
wait. Just understand there is a price of waiting as well, right? So what we just talked about, if the rate today's at 7, or I wait 6 months and the rate's 5.5, I guarantee you one thing: the difference in payment versus the difference in price and what you can get. Because we haven't seen the last 2.5, 3 years. Nobody was paying closing costs. Nobody was paying under ask. Well, guess what? We're starting to see a little bit of softening there. Not much, but we are starting to see some.
right, in
So
other
does
areas
it?
are a lot more they're more
Yeah,
the thing is that sellers are now knowing that they are not running in the driver's seat. So there is a
that's right.
lot of negotiation opportunity for people, whether they're in Louisiana or in any other state. There is an opportunity for at least you to be able to do that because it didn't exist a year ago, did not exist.
Absolutely.
And so,
Absolutely.
yeah, like see what you can do, and like, and check with your lender to see if you can get where they buy down the rate for you with those
Yes.
closing costs. That would be fantastic. I missed the comment beforehand. Emmanuel, thank you so much for the $2 super chat. I appreciate it. I missed the question that you had up there earlier, Eddie, and I wanted to go ahead and read that. Richard has a question, says, do you see real estate agents not returning calls, texts, emails so they can sell the home to one of their preferred customers or investors? This can't be legal. Can we, what can be done about it? Well, I have an answer for that. Do you want to chime in first, Ryan, or?
I'll let you take that one.
Okay, so if that real estate agent is not answering your calls about that specific listing, go to any real estate agent in that area, anyone on the planet, and have them call in and make you an appointment to go visit that house, right? If the listing agent isn't willing to work with you, there's about 1,000 other agents that are going to be more than happy to work with you. If you're still not getting any kind of response, even with that agent, call that listing agent's broker and say, hey, I've been trying to get a hold of that listing agent. They are not answering their calls. I've sent text messages. I've sent emails. They're not willing to work with me. I don't understand this. Can we get this taken care of? And then you should be able to get some kind of response. But anybody on the planet, even if they're not the listing broker on that sign, can show you that specific house as long as it's listed in the MLS. And you should be able to work with any agent in the area. I don't know. It depends on the state if they consider that legal or not. By law here in Louisiana, any kind of offer that is given, if it's put on a contract and it's signed by you as a buyer, by law, the listing agent has to show it to the buyer. They cannot not show it. And if you're ever concerned that they never showed the buyer, tell them they have to send it back to you signed that the offer was rejected. Sometimes listing agents won't do that, but if you are in perfect, like if you are, for a fact that was never even shown to the sellers for your offer, tell them they have to, by law, if you're in Louisiana, to give it back to you within that the sellers signed it and they checked off rejected. So there's that. Awesome. All right. Byron Thomas says, on the resumable, I'm assuming they said assumable issue, the difference goes to the current seller of the property or to the lender. On assumable properties, does the difference go to the current seller of the property or the lender? Well, if they only owe $100,000 and their offer was $200,000, it would go to the seller because the lender only needs $100,000 to be paid off.
That's right. But what I was saying on that is that they just will not allow you to finance on the assumable part. The assumable part is just simply the amount that the guy or the gal owes. And if it's a higher price point, then you got to bring, or the buyer's got to bring the difference. And that's why most assumable mortgages, unless somebody is just in a bind and they just bought it and they're going through a divorce or something like that, that would be an issue to where an assumable loan could come into play and really help the buyer. But in most cases, the buyer's not really benefiting much from that.
So but for instance, say they bought it when the interest rates were like 2.25, right? Mm-hmm. And their area after that didn't gain in equity that much. That could really work out for you.
Sure.
That could really work out for you and the seller. But yeah, because you're helping them out, and so they don't have to like short sale or go into the foreclosure process. So there's always look to see. I mean, you can look at your county websites to see how much their mortgage was, because it will say, like, it will show the property address and then like what they purchased the house for. So you can look under that. I know you can here in Baton Rouge. Baton Rouge allows that. Livingston Parish allows that, and so does Ascension Parish. And even in Louisiana, though, the parishes have different housing markets. Each parish has a completely different. I mean, and it's like literally right next door. So always check with your local real estate agents to see what's really going on in the market. Get something called a CMA. Peter has a question. Says, what happens to nominal housing prices if the rates just stays where they're at for now for a few years? Like if they were just to stay for a few years, what would happen to housing prices?
I think what I said earlier is you're going to see the sustainable growth again. And I know different markets see different things. 2008, I keep referencing to this because I lived through this, and this is what everybody compares it to, right? Mm-hmm. That was an awful time, right? Mm-hmm. No doubt about it. It was not fun for anybody. You had houses on the East Coast and West Coast dramatic drops. But what people fail to realize is you had dramatic increases. You had some places, Miami, you had some stuff in Jersey up
Las
25,
Vegas,
30% a year,
Phoenix.
which is non-sustainable. So I think what you would see there, Peter, is you would see the consistent 3 to 5%, which is sustainable. Could you see a little bit of a dip? Yes. If we looked at every micro market, sure, I'm sure we could pick some out. But the majorities would always say the masses, the 80, 85%. I think you're actually going to see a nice, stable increase. And so nothing crazy, but there's so many benefits, right, to going back to the home ownership piece that I've seen, not just from the investment side, but actually owning my own home. This is our fourth home Chantel and I have had, that we've consistently seen the increase no matter where we've lived. But you got the benefits. There's 5 benefits of home ownership. Those haven't changed. You got a stable monthly payment, right? I don't have to worry about one of my landlords coming in and saying, hey, look, I'm deciding to sell this thing. You're building equity. You're building, a legacy for your family. And at the end of the day, I'm not going to tell you that you're having it for a tax liability or tax opportunity. I don't even go there with my clients, but I do tell you that the wealthiest of the wealthiest, they figured out the whole entire deal on that real estate piece to where they're depreciating that asset, where they're also cost segging those in a lot of places. And so there's so many other benefits outside of appreciation and rate. Hey, you got to be able to afford it. You got to know, going back to the local market, hey, there's experts within inside your market that you're living in that can say, hey, here's where it's been for the last 5 to 10 years. And I think that's a good indicator of where we're headed. That would be my thought on that.
I always call it I think that a lot of areas around the United States is going to have a stagnation where it isn't increasing. It isn't really decreasing enough for people to want to jump in and buy. So it's just the market's going to end up stagnant. And I think that's going to be a problem for a lot of areas across the country for the next couple of years, in my opinion. I call it the great stagnation. That's it. That's in my brain.
The stagnation. I like it.
Yeah. I'm hoping that it'll catch on. People start using that. I'll be like, I'm the one who started that.
I started that.
Miss Shadow Llama has a question. I have a conventional loan with a 10% down. I've been in the home for 2 years as of November. We gained a property appreciation 40% in Tampa. Should we be able to drop our PMI if we get an appraisal? Any concerns with that?
Absolutely. Fantastic. You did great. Absolutely. Anything below 78% equity position wise, you can remove the PMI. It doesn't require you to refinance on a conventional style loan. So you did exactly what you needed to do, and you're in great shape. So yes, you can remove that PMI.
I have a question about that. So let's just say you're in an area like Phoenix, Arizona, and you did drop that PMI, and then the area drops down in price so much that now that threshold has changed. Can they add PMI back on it?
Nope.
Oh, okay. So they can't come back to you and say, yeah, you dropped it, but now we're going to put it back on because the valuations of your area have changed. They can't do that.
Cannot. Nope.
Oh, that's good to know. That's good to know. Eddie's going to be putting up the next question. I always wondered that. I was like, ooh, I wonder if they could be sneaky that way. That would stink. Julie Turner has a question. I just listed my house after a week and we are under contract for full asking price. So did I just find a unicorn holding a 4-leaf clover, or are they just, are they still selling? It depends on your area. So there's plenty of areas that are selling crazy, right? But it's hard to believe that when you start like flipping through even CNN, any kind of realtor magazines, anything like that, because what sells papers, what sells clicks, what sells people to entice them is doom and gloom type of headlines. So they'll take an area, like for instance, Boise, Idaho was the hottest headline for the longest time because they had a great decline in home prices, of listing prices. They had dropped 25% in that specific area in that period of time. And people were like, see, it's starting. That's it. The whole housing market is crashing. It's going to be epic. It's going to be worse than 2008, right? Because that gets people it gives them an emotion and it gets them to sell papers. So every single market is going to be different. There is many places around Atlanta that have still been selling over asking prices. There is tons of places around Tampa, Miami, around those areas of Florida that are selling still over asking price. But if you come to our area, we're going to be having a more of a balanced market. The houses still sell. They still sell fast, especially if they're under that 300,000 to 400,000 mark. You're gonna have a lot of people that come in and look at your house, but you're gonna have more of negotiation, at least with the sellers. They're not gonna snub you and say, "Oh, you're not gonna give me $20,000." You're gonna have those negotiations that you would hear. But that may not be the case in other places. But if you go to like Austin, Texas, you're going to be able to negotiate even more because they had such a rampant rise in home prices. They have a ton of new construction that still has been hit the market. So you're going to have a lot more negotiation rooms in that specific state. That's why it's very important to know what's going on in your market. If you sold it that fast, ask your real estate agent if that was just one of those things in your area. Was it like you got lucky, or your real estate agent will be able to answer that question better. How do you feel about that, Ryan?
No, I think that's, I don't think it's a unicorn at all. I bet you that it was probably marketed right, priced right, because when we see houses in my market right now, in our market, priced right and marketed right, they're selling,
They're
period.
selling. Yep.
I mean, in just what you just said, below that, say 350. Now, a lot of these builder incentives with these new constructions, I mean, think about this on that 2-1 buy down. So you've got some folks now that are throwing the kitchen sink at these builders. But in my opinion, again, knowing what I know, there's still a lot of fat on the bone, if you would. So for them to say, hey, we're going to do a 10, 12, $15,000 towards closing, they're using that to buy the interest rate down and use that to go towards some of the closing costs. So, hey, you can benefit in a great way right there. So don't get so fixated or so short-sighted or short-minded that, hey, look, well, yeah, just the rates are here where they are. No, again, going back to the need thing. Hey, my kids are about to graduate. I'm going to sell this house at this price. It's going to be a fair price. We're going to market it right. We're going to do everything like that. And then we're going to go downsize to XYZ. That happens all the time in any market, no matter whether rates are high, rates are low, recession or not. That's what I would say. So good job. I think the answer is it was priced right. It was definitely marketed right to sell that quick.
Question: do you guys think rentals will be more in demand due to the interest being so high? It's harder to qualify for a home loan right now. Do you think it will be rentals become even more in demand because of the restrictions on buying a house? Like, what do you think?
I can tell you a lot of these rentals that I'm finding and a lot of the conversations that I'm talking to buyers day to day, a lot of these companies are being flipped. So these apartment complexes are being bought by these huge companies, and then they're coming in and flipping those, meaning that, hey, you are paying $1,250, your lease is up, we're going to increase it to $1,400. So
Correct.
you got to make a decision. So my thought there would be, I think it's going to continue. Again, supply and demand. It's not like rent prices tomorrow are going to go just back down. They were making money at $1,250. They're going to try to make more at $1,400. But even if they got to flip it back to $1,250, at some point you got to look at it and say, man, I'm paying $15,000 a year for rent, and I've got my neighbors on top of me. I got their dogs, their kids fighting, and I have nowhere to park outside. I'm going to go buy a house and pay, $230,000 house. You can get for dang near $1,400-$1,500 a month with taxes and insurance and everything. And I think people overall are just like, man, I've heard about this home ownership thing. We've not done a great job as a country, as an industry, of creating that financial literacy, of explaining all the benefits. We always highlight all the problems, but what are the true benefits of home ownership, right? And I think that, going back to where it's just the world I live in every day, I see people with more credit card debt than ever, more student loan debt than ever, because they weren't properly educated on this is going to impact you long term. Therefore, you might not be able to buy because your debt to income ratio is out of whack. So you're going to have both. But I believe as long as you have these large companies buying these apartment complexes, which that's huge money in that, and they're flipping those and they're getting more return in rent. It's going to create the demand even stronger.
But if we're being realistic, how many houses can you find now in the 200s or the 250s? I mean, that's the unicorn. That's really difficult to find
It
nowadays.
it is, but I think what we're starting to see, at least in my world, smaller
Mhm,
world, here in Baton Rouge,
mhm.
I am starting to see people buy those homes, not new construction, of course,
Of course
but
not.
people are like, "Hey, look, I bought this house 7 or 8 years ago." Because you got a lot of people right now that want to move that they don't know where their next move's going to be, so they're not
Mhm,
doing anything. So you have that's a whole nother conversation piece in itself.
mhm.
But the people that bought those houses 5 to 7 years ago for a small price, if you will, are able to look at it and say, man, I can sell this house and make 40, 50, 60,000 and this amount of time. I'm gonna do that and make that move up. That's what I'm seeing. Now, you're not having the guys that bought that $300,000 house wanting to make that sale and jump up to the 500. That's where the
Mhm,
big lag or disconnect is. But
mhm.
that lower price point, that below 300, you're seeing a lot of people now really benefit because they bought that house 3 to 5 to 7 years ago and see how
Yeah.
much equity they built up. And they're like, man, I want something new. Who doesn't? That's kind of the
Mhm.
world we live in. If it's
I like
nice,
my
it's new, and
house.
it smells.
I bought
I
my
hear
house
you. I
under
love my
300 and I'm gonna stick in it. Like, I'm just gonna
amen.
stay here.
Yeah.
Nate Morrissey has a question. Says, "Any advice in finding the best rates for a home equity loan or lenders that do them, not HELOC? Happy birthday, Christina." Thank you, Nate. I appreciate it. Do I look a year older? So
Absolutely
what do you
not.
think about home equity loans, not the HELOCs? What is the best way to find the rate?
Yeah. So there's. I just want to make sure I'm clear on this. So the house, let's say the house is paid off,
Mhm.
right? If the house is paid off, you just get a normal loan. We do those all day long. So hey,
Mhm.
look, I want a fixed rate mortgage with no prepayment penalty. The true home equity line of credit, that is 100%, in my opinion, the thing right now, which most people, we have not seen this because rates haven't been up. When rates were
Mhm.
low, the home equity lines were super low, right?
Mhm.
But you're going to see a lot, just like the credit card debt, right? When the rates were low, credit card monthly payment wasn't a whole lot. Well, now that interest rates are up and they continue to do what they're doing, those things are moving up. And so these lines of credit, I think you're going to start seeing more people say, hey, time out. I want to put this on a fixed rate, which again, depending on where you are, if you have a first mortgage and you have a second mortgage, the second mortgage rate's always going to be higher than the first because of where it's sitting. But the true home equity lines, you're going to start to see that interest rate increase a little bit rapidly because of where they are. But when rates come back down, that'll curve. The problem that I have with home equity lines, and look, I have one on my house here. We don't owe anything on it.
Right.
It's for an emergency and emergency only.
That's why I have one.
You do not use that for anything else other than that. And it is, if you use it or have to use it, you get super aggressive to pay it off because that's an interest only, and the rate is accumulating daily, just like your credit card. So
Right.
it's not like a mortgage at one time a month. So that's again a misconception. A lot of people, well, man, I'm just going to get a line of credit. I'm gonna borrow against that line of credit. You could do that, and the payment's going to look super sexy and super low, but you're not going to impact the balance because it's an interest only type loan.
Right. Yeah. Well, though, it's always good to have something that you can lean on because it is your credit. I mean, it is your money after all. So you can tap into it if something was to come up that was unexpected. So I always encourage
Absolutely.
people to have a HELOC. They had a lot of people had a hard time during the pandemic getting their banks to get HELOCs. A lot of people were having a real tough time being able to, uh, get one for their specific home. Became a
Right.
problem. And Jackie Flint has a question. I read an article that stated that a $300,000 home is $800 more than this time last year due to the increase in interest rate. Does that sound correct? Yes. With the interest rate that it is now. Yeah, that sounds correct. I would go to say it's probably more than $800, don't you think? For
I
between
saw
like,
that.
don't
I
you think
saw
it's
that same article. I think it's pretty close. I think
okay?
you're probably, yeah, your buying power. No, there's no doubt. It wasn't a quote unquote sales pitch that when rates
Mhm.
were in the threes that your buying power was as high as it had ever been. And yeah, I think looking at where things are now today, yeah, of course that would impact that monthly payment on that 300,000 or $400,000 house.
Mhm.
Again, knowing what we know, seeing people's income every single day, and looking at credit and income, it's one of those things. They can afford it. It's a matter of if they want to afford that payment or not. That's the
Mhm.
big difference. Going back to the need thing, let's talk about what are we really trying to accomplish here? I mean, okay, well, I've just had my wife's now working, and we had an extra kid, and we need extra room. Then yeah, they're probably going to pull the trigger on that. But that does sound about correct. Your buying power was super, super, super high at 3.5%. But you know, I think you're going to see when rates level out, I think that price is going to be a little. I like the stagnant stuff. I'm gonna kind of use that,
Yeah.
but I do believe that you're going to see that stagnant price point stay
Mhm.
for a little bit. I don't think we're going to see these massive. I think the prices are going to correct some, yes, but I also do not firmly believe with all of my heart. I would love to see it. That you're going to see this dip in price, major dip in price. I don't see it. Not with the pent up demand out there and the price of rent going where it's going.
Yeah, because even if someone was to lose their job and they're like, "Oh, man, I have no choice, I have to sell my house," and they let's just say they bought their house in 2018, so they've had that house for good 4 and a half, 5 years, and they're like, "Oh, I have no choice, I have to sell because I can't make the mortgage payment." They're gonna put it up on the market, they're gonna sell it fair market value, let's just say it's a three-bedroom, two-bath, and normally it would have sold for 400,000, now it's at 325, so they put it up on the market, they're gonna sell that sucker, and they're still gonna have a buttload of equity to play with. They're not putting it in foreclosure, unless
No,
they're just pig-headed and they're like, "No, I'm not gonna pay make another payment." The bank is like, and there are those people. I've met
yep,
those people. They're like, "No, I'm just gonna stay here until they kick me out of the house,"
yeah,
instead of trying to sell it. But the majority of people will just go ahead and sell because they have so much equity in their house. Even if they were to lose their job, they would be okay. It isn't the same as last time because people were so overextended with the home values being at what they were. They did 100% financing on their house, sometimes over 100%, depending on their loan package. And they had no choice. They had to either for short sale or foreclose on. So
yep.
MHO8 said, instead, you have to worry about the city saying, "Oh, by the way, we're raising your property taxes, $1,000 a year." That depends on the area. There is a law, amendment on the ballot right now here in Louisiana that talks about the increase in property taxes. So don't
Hmm.
forget to go out and vote on Tuesday. So and look at those amendments, find out what they're saying on them. Voting is important. Voting is very
It is
important.
very.
Did you see, I forget what number that is. Did you see that though about property taxes and increasing? And then they talked about veterans having increasing on their property taxes?
I did see that. I think I look. I know Louisiana, and I know there's other states that have different things, but that if it's your primary residence and homestead exemption for the first 75,000, I mean that is a huge benefit.
Yes, it is.
I mean that's $700 to $900 difference a year in your property taxes. So I mean, there's a lot of things that we got to pay attention to, right? I mean, it's no secret, insurance has been a big problem in Louisiana with all the hurricanes that we've had over the last
Florida's
couple of
worse.
years. Yeah,
Florida's
Florida is
worse.
now. Yeah, Florida's is in a bond. I would do quite a bit of business there as well. So there's a lot of things that we've got to all take into consideration for sure. But one thing I've learned after the flood and different hurricanes that we've been through here, just like you have companies that come in for a while and do what they do, then you'll have those companies get cleaned out, and then you'll have a new set that'll come in. I mean, that's what we've seen and what typically happens.
I know you're from Louisiana because you refer to everything as far as history as what weather event happened. So was it
Oh
before or
gosh,
after Katrina? Was it before
Katrina.
or after the Great Flood of
Gustav,
2016?
yeah, yeah. We've seen we have our issues. There's no doubt.
We do, we do. Um, it was Amendment 6, limit on assessed value increase, reappraise property in Orleans Parish measure. Yeah, and then they had this other thing. Oh, in some states too, if you are a vet and you are retired, you may be able to qualify for another exemption on top of that. So check with your local state of, and find out if you do get another benefit. In some states, even they are like, if you're over the age of 72, you get a benefit, another tax deduction benefit. So always check with your local community tax office to see if you get some kind of benefit if you're over a certain age, or you've worked for the federal government, or you were ex-military. Just check to see what you get your money. Like if you can get a deduction in taxes, take it. Take it. You don't win an award for paying more in taxes than you should have. They don't get you, they don't put your picture in the paper. Louisiana military benefits. Oh, what website is that? If people want to check that out, Eddie. Oh, Eddie wants to show me something. Eddie wants to show me something. He's going to scroll down. Eddie's anomaly. No one ever gets to see him. He's like Mr. Wilson, creeping over the fence. No. Property received the standard homestead exemption, which is owned by and occupied by a veteran with service connected to the disability rating of 100%. Unemployment or total disability from a VA is exempt from the parish ad valorem taxation for $7,500 up to a maximum of $15,000 of assessed value. So that's what they're proposing, that you add to your tax exemption if you are a veteran.
Nice.
I know, right? I'm like, yes, that's okay for me. I'm okay with that. Question: do you have any projections for Central Florida in the next 1 to 2 years? It seems to be all over the place with it crashing and going to the moon and with increasing. I'm going to just tell you my personal experience, what has happened to me in Central Florida. During the last housing market explosion, I was living in Florida in 2007, and I knew darn well that my house was not worth what they were saying it was valued at that time. Told my husband to get on the computer, find anywhere we could move to that the company would transfer us, right? At this time, I don't know what has gone on as far as new building is concerned. My best piece of advice is to talk to Ken Pozak in the Central Florida area. He has a whole team that covers that whole Central Florida area. He will tell you exactly what he feels the market is going to do, because they've had an increase of like Airbnbs and a lot more investors that are using a lot of homes, those smaller homes like mine was in Florida, as investment properties for rentals. I cannot predict what I believe will happen in Central Florida, but if the last housing crash is any reflection to what the correction would be for this housing market, they could face some big deductions. But I just don't know. I don't know what the rate of building time there is, and I don't know how many new properties are there. I don't know what new construction is there. But if it looks exactly like it did last time, they're gonna get hit. I don't know. Serenity Cow says, Ryan, how do you think the higher interest rates will impact corporate investors? How do you take on debt to buy homes? What would trigger them to sell off hundreds of homes that they own?
The only thing that I think would trigger them was if the bank were to call the loans, which I can, again, go back to the type of loans that are being done. There's a loan right now that we're doing for investors. Okay. It's called a DSCR loan. Okay.
DSCR.
Yep. So basically, I want you to think of it this way. The borrower or the investor has to put a minimum of 20% down. Okay. It's a fixed rate loan with no prepayment penalty. We can do that loan over a 30-year, basically 30-year amortization. So the cash flow position for that borrower, and we're not the only one doing this, by the way. Lots of companies are now doing this, 30-year fixed. What's the caveat, Ryan? The interest rate is higher, yes, but the 30-year term makes the cash flow for the investor even better. So unless they get us some crazy bind and they got people that are not paying, which again, we can sit here and debate that all night long, they're in a great equity position. Their cash flow is good because they're on a fixed 30-year loan. So the higher rate really doesn't have anything to do with that specific situation, if that makes sense.
Right.
The
It
rate's
does.
not fluctuating. And most, if you go back and study, most investor loans from your smaller banks are like on a 3 to 5 year loan, but it's amortized over a 15 to 20 year. Whereas now they've even come out with investor style loans that are basically 30-year fixed loans, but they do have to put a minimum down of 20%. But they're like, well, heck, I'll go pay a higher rate because if I can pick up that 10 or 15 years, it really helps my cash flow. Again, people are using this as their alternative to the fluctuation in the stock market, guys. I mean, that's just what we're seeing.
Right. Well, I tried to get you to do that on one of my rental properties.
I know.
We got all the way down to the end, and then we found out because I think it's because the houses were connected, or was it because they were both
property?
Yeah, it was they were connected and they were on 2 different meters. I was like, oh my God, so mad. So mad. Oh well. Poll results. Oh, I had a poll that said, how much do you think the Fed is going to raise it the next time? How much do you think it's going to be raised the next time? If it's going to be raised up?
My honest opinion is probably 50 basis points. I was thinking before this, it could have been 50 to 75. I think you're going to see 50. I would be shocked to see another 75. I think you'll probably see 50. And I think over the next several weeks, we're going to see a lot more information start to come out that you'll see talking about taming the inflation. And really, I think we can beat that again all night long as well. But I mean, they're doing it and they're doing it fast. And I think really you're going to see things stabilize here in the next 30 to 45 days, tamper down. And then I think they're going to come out and say we're in a recession, which they should have already come out and said that because we are. But they have not for whatever reason. Recession breeds lower interest rates. You can go back and look over the course of history. Every time we go through a recession, right there quickly after, you see lower interest rates.
So the results were that said 47% say Fed will increase it by 75 basis points, 29% say 50 basis points, 17% say only 25, and 7% say they'll just stick where they're at, stay the course, stay the same, and not change anything. Cool. I'm with you on the 50. It just seems like that's the pattern, you know. It's not like it was my crystal ball thing. It's not anything that was what my crystal ball says. Well, Ryan, we have been talking for 1 hour and 22 minutes. I want to know how people can find you on the old interwebs.
Absolutely.
Go ahead.
I know I gave that to Eddie, but I run a little small team here in Baton Rouge. I'm with GMFS Mortgage. Ryan Larussa. I am out there. Smallhorn would be excited now. I'm out there on a couple different platforms. But I'll let Eddie put that information up there. But I love to talk to people. I love to kind of educate people. You can give me a call, 225-214-5153. You can email me. I am good about responding back. I'm not going to leave you hanging. But I would love to spend some time with you. Anything I could do to add value to you guys. Smallhorn, this was a huge blessing. I really want to just tell you thank you, Eddie. Thanks so much for everything you've done to make this happen as well. And hopefully we can do this again soon. This was fun.
You'll do this again? You'll talk rates and
I would
housing
talk
market
whatever.
with me again?
Look, we can talk whatever you want. It seems kind of boring. We can talk whatever you guys want to talk. I would be happy to add value.
We
again,
did
I don't know
not
everything.
talk about reverse mortgages. I'm going to have you on again. We're going to talk reverse mortgages.
Let's do it.
Yeah. And if you guys are having a problem finding a real estate agent in your area, please go to my website and fill out the referral form. I will connect you personally with somebody that I know. I'm connected with thousands of agents across the country, and just reach out to me. Make sure you put your phone number. I can't really call you unless you put your phone number down. But if you do know me and you've known me for a period of time, and you do call my phone, the first thing I say, what do you want? Isn't that right, Ryan?
That is what she will say. Do not get offended. I don't get offended now either. I'm just checking in on you, Smallhorn. But what do you want?
Yeah, so just fill out this referral form that Eddie just showed right there. All the pink buttons take you to the same spot. Just fill that out, but put your contact number. I can't call you unless you put your contact number. So I want to say thank you so much, Mr. Ryan. I want to say thank you to all the moderators that always keep our chat looking really good every single week and keep out the yuckies, and if you have any questions after the stream for me or Ryan, just make sure you put it in that comment section below. I'll make Ryan go over there and start answering people. So, all right, Ryan, thank you so much. I appreciate you. I appreciate every one of you that was on the chat. I think we had over 455 people. So I appreciate everybody that came on here, and we'll see you next Sunday. Bye-bye.
See you guys.
We have to dance now. Oops, he hung up. He was done, man. He just closed it out. He was done. Thank you, everybody.